You're listening to Capital Topics, episode number 68. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll review the Morningstar US Mind the Gap 2024 report, which highlights how investor mistiming the market has an impact on their performance. Enjoy! Good morning, James. How are you today?
I'm fine, François. How are you?
I'm fine, thank you. Maybe a bit of a cold, but I'm good. So for our topic today, we'll look at the results of the latest Mind the Gap report from the Morningstar. This report analyzes the difference between the return reported by U.S. mutual funds and exchange-traded funds compared to the returns actually obtained by investors. The latest report, released on August 15th, covers 10-year period ending on December 31st, 2023.
François, I think our listeners will find this topic very useful. We alluded to it at the end of our podcast number 63. In that podcast, we covered the performance results of actively managed funds against their respective passive counterparts, and we touched upon the spectacular growth in the market share of passive funds.
Yeah, correct. And back then I mentioned that I thought that it was encouraging to see the growth in the market share of passive management and to see the continued outperformance of passive versus active funds. However, I concluded by saying that investors needed to make good use of the tools and invest in a disciplined manner with an eye on the long term. This warning stems from the fact that investor behavior has a meaningful impact on the performance, whether someone uses active or passive funds.
You're totally right on that point, François. Investor behavior has a meaningful impact on performance since emotions often drive our investing decisions. It often comes down to fear and greed. When markets are rising, investors get greedy and want to buy more. When markets are falling, investors want to sell as they fear losing money, which in extreme cases can lead to panic sell-offs. So our listeners may find it interesting to know that Carl Richards, an American financial planner and a New York Times columnist, is credited with coining the term behavioral gap. He wrote a personal finance book by that same name, and the term behavior gap coined by Mr. Richards refers to the difference between what investors really earn as a return versus what their funds actually return and in the published data.
Yes, and this difference is precisely what the Morningstar Mind the Gap report is trying to quantify. Because unlike the returns calculated for the funds themselves, the returns calculated for investors considers cash inflows and outflows. If investors are adding value through their buy and sell decision, the gap will be positive. And if, on the other hand, their decision subtracts value, the gap will be negative.
Well, François, with that being said, what are the results of this year's 2024 Morningstar report?
Well, James, the report highlighted, once again, that the returns actually earned by investors were well below the returns generated by the funds themselves. For the 10-year period ended December 31st, 2023, Morningstar estimated that the average dollar invested in U.S. mutual fund and exchange-traded fund, meaning the returns earned by investors, was 6.3%, while the funds themselves earned about 7.3% per year. The difference, rounded up to a negative 1.1% by Morningstar, means that investors lost about 15% per year of the returns that the funds generated over the decade.
Well, this small difference of 1.1% per year over a lifespan of investing really represents a huge impact, and there's a compounding factor at some point. And again, when you're trying to accumulate as much assets as possible for retirement, that gap is going to hurt. So it's really important for investors to understand the effect that such small differences can have on their portfolios over time. So correct me if I'm wrong, François, but the gap experienced for the decade ending in December 2023 is actually very similar to what was reported in prior year Mind the Gap reports by Morningstar.
Yeah, you're right, James. And if we look at the gap on a yearly basis, the average investor return lagged the average total return of the funds in all of the 10 calendar years of the last decade. The lowest yearly return gap was a negative 0.7% in 2017, and the highest return gap was a negative 2% in 2020. According to Morningstar, the poor results of 2020 is due to bad timing by investor as they added assets early in the year before the market dropped and then withdrew funds during the meltdown just before the markets experienced a strong rally in the following months. This is concrete proof of investors' poor behavior impacting their investment results.
François, I'm not surprised by the results for the pandemic year 2020. It was a very difficult year to keep clients on track with their long-term investment plan. The COVID crisis was a big unknown for all of us, but so were all the other crises before that. We have said before on this podcast, market timing is very difficult and a great way to dilapidate capital. And it's also a great way to reduce significantly your long-term returns. What's important is timing the market and not timing the market. François, are there any other findings you would like to highlight in the 2024 report?
Well, James, if we look at the fund categories, there are 8 of them. Investor returns lag the total returns of the funds themselves in all 8 categories over a 10-year period. The fund category with the smallest gap was allocation funds or asset allocation funds, with a negative gap of only 0.4% per year. The investors' return was 5.9% and the allocation funds return was 6.3%. The fund category with the widest gap was sector equity funds with an investor return of 7% and a fund return for the category of 9.6% for a negative gap of 2.6% per year.
Well, François, I'm not really surprised by the large gap for sector funds. I mean, people often jump in after there's already been a strong rally. I believe that this fund category is often used by active investors who want to increase their exposure to a particular sector for its growth potential. They're also used by investors who want to position their portfolio differently depending on where we are at in the economic cycle. Again, to me, these are all examples of market timing decisions.
Well, James, the report does not explain it like that, but if you interpret what it's saying, you're about right. The report says that the large negative gap for sector equity fund is due to fund flows being about twice as volatile as for allocation funds, meaning that investors are likely jumping in and out of those funds. The other reason is the fact that the returns in that fund category are 50% more volatile. The report states, and I quote, "The more volatile the fund's returns were compared with peers, the larger its investment return gap tended to be on average." For instance, the average dollar invested in the most volatile quintile of sector equity funds lagged the buy and hold return by more than 7 percentage points per year. That's huge.
Wow, that's a huge gap. So, François, I imagine the reverse is true for asset allocation funds that automatically rebalance without investors' input.
Correct, James. We can also say the gap is smaller for this category of funds because the funds flows are more stable and because the returns are less volatile.
Again, it makes total sense to me, François. When you invest in asset allocation funds, the returns are going to be more stable because of the diversification benefits you're getting. For instance, these asset allocation funds will likely have holdings in bonds. The bonds will play the role of stabilizer, and this in turn reduces volatility, which leads investors to most likely behave by staying the course in difficult markets.
Correct, James. And less volatile the fund is, the better the investor is positioned to capture long-term returns.
Is there anything else, François, that stood out to you that we should highlight for our listeners?
Yes, there's a couple more things, James. First, I'd like to comment on the negative gap that exists for municipal bonds and taxable bonds. I'm surprised the report does not discuss this. Although their respective gaps are narrow, 1.3% and 1% respectively, I believe that these gaps are high relative to the performance of the funds in these asset classes. Since the municipal bond group had a return of 2.8% and the taxable bond group had a return of 2.2%, the negative gaps experienced by investor means that they left roughly 46% of the returns from bonds on the table for the last 10 years.
Well, again, it's a very good point you make, François. It's surprising and counterintuitive because we assume that normally bond returns are less volatile. At the same time, I think we can attribute this to the historically high negative returns and high volatility experienced in the bond market in 2022 due to the spike in inflation and the subsequent increase in central bank rates.
Yeah, perhaps, James. No explanation on the report for that. The other thing I'd like to highlight is the poor performance of alternative funds category, which includes hedge funds. And I think you'll like this, James. I quote the report. Alternative funds earned the dubious distinction of being the only category group where the average dollar lost money over the decade, as it posted a negative 0.4% investor annual return. The report goes on to say this is somewhat ironic considering the sales pitch for some alternative funds is based on their ability to preserve capital.
Well, that really puts a dent in alternative fund manager sales pitch, François. I mean,
Indeed.
a negative return over a decade when U.S. equities have returned over 10%. You honestly have to question the merits of these funds for individual investors, especially considering the fact that no other fund category had negative returns over that period. To me, the likely explanation is that the outrageous fees of these alternative funds explains the poor performance. I'll remind our regular listeners that in podcast number 64, when we were talking about the Warren Buffett's annual letter, I quoted Jason Zweig of the Wall Street Journal, and I'll share the quote again. If Buffett had charged conventional hedge fund fees, his investors would have earned only about 10% of the wealth that they have enjoyed. So, it's just staggering, right? 90% of your returns are given up to fees. High fees reduce returns, but outrageously high fees destroys returns. Is there anything else in this report you'd like to highlight, François?
Yeah, my last point, and this brings us back to our introduction when I said that investor needed to make good use of passive tools at their disposition and invest in a disciplined manner. The report highlights that overall investor returns in passive funds were higher than in active funds and that the negative return gaps was smaller for passive funds.
So this is really good news for passive investors, but again, not all investors use ETFs passively. That's an important distinction.
Yes, the report highlights that when investors deviate from U.S. equity and international equity categories and into other fund categories such as sector equity, non-traditional equity, the negative investor gap widens quickly and were worse than the negative gaps experienced for an active investor. The report states, and I quote, "This suggests investors could be forsaking the cost advantage they enjoy in such funds in their zeal to trade."
Well, François, we have often shared with our listeners that one of our core beliefs is that active trading reduces your chance of creating value. The Morningstar report, to me, supports this thesis. The behavioral gap results for sector equity and non-traditional equity are compelling. You've alluded to this in the past, François. ETFs are great tools, but must be used wisely.
In addition, James, even when investing passively, capturing capital market returns of multiple asset classes is very hard to do. You get caught up in the latest news or latest fads, and then your emotions get in the way, and you react by trading. Passive ETFs are great low-cost tools to capture market returns, but they are also double-edged swords because they can be traded easily when the markets are open. To this point, some investors could be better served using index mutual funds than index ETF because a negative gap for index ETF was a lot wider at a negative 1.1% versus the index mutual funds at a negative 0.2%.
Well, this statistic to me, François, is very compelling about investors' behavior. I think it is fair to say that to narrow the negative investor gap, investors should hold a small number of broadly diversified funds in various asset classes. They should favor simplicity and avoid excessively specialized or niche funds such as sectoral or thematic funds. Finally, they need to manage their behavior, and the best way to do it is to have an investment plan and to stay the course in difficult markets.
I could not agree more, James. And as Bill Bernstein, neurologist, financial theorist, and author once said, and I quote, To the extent that you succeed in finance, you succeed in finance to the extent that you can suppress your limbic system, your system 1, which is the very fast-moving emotional system that we all have. If you can't suppress that, you're probably going to die poor.
Well, again, François, I think that's a really great quote from Bill Bernstein. I think it says it all. So that's a great topic today, François. I hope our listeners enjoyed what we shared with them.
So that's it for today. Thank you, James, for sharing your thoughts and expertise.
My pleasure, François.
So that's it for episode number 68 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on November 20th. In the meantime, make sure to consult Capital Topics website for our latest blogs. Thank you, and see you soon.